Intel has been absolutely cut in half since it began its catastrophic decline back in 2021, which now puts them at a market cap of 124 billion, a PE of less than 10, and a dividend yield of almost 5%. And well, if you clicked on this video, you know it's now time to analyze their Q4 earnings results so that us value investors can get a good idea of where things stand with Intel, if it's a buy, if it's a sell here at these current levels. So make sure to stick around to the end of the video as we'll answer all those questions and more. How's it going? Welcome Everything Investing. I hope you're having a great day. Today we are going to go through the usual, the fundamentals of the business, the trajectory of the business. We'll take it all into account, and then finally we'll conclude with an evaluation of this business using our intrinsic value calculator, and we'll end off the video discussing our investment rating for Intel. So if you do enjoy this type of content, make sure to like the video, subscribe, comment your thoughts in the comment section below, and without further ado, let's jump into the analysis. Okay, so Q4 2022 earnings for Intel, and let's talk a little bit about what we knew coming into this. We know they're going through a little restructuring change here. They're committed to delivering $3 billion in cost savings by the end of this year here, so that by the end of 2025, they can actually achieve about $10 billion in cost savings. We know they are going through a challenging period right now. Q4 was not amazing. We'll talk about that more in just a second. And they say that this is all a part of their long-term strategy. Now, let's really see if that is true, because I don't know, it's not sitting right with me that if we look at these Q4 financial highlights here, revenues are down to $14 billion, at least for this quarter. That's down 28% year over year, like they mentioned at the low end of their guidance. Now, gross margins are down to 43%. Those are still actually decently high, but they're down another 12 percentage points year over year, below what they had expected. Same thing with earnings per share. Those are down to just 10 cents per share, down 92% year over year, and also below what they had expected. If we look at this from a full year perspective, $63 billion in revenues, those are still some strong numbers, but it's down another 16% for this year. Gross margins down ultimately to 47%, down 10 percentage points. Again, worse than they had expected. And same thing with earnings per share, still at $1.84 for the full year, but that's down 65% year over year. Again, another thing they did not expect there. Now let's break down their segments a little further. They have Client Computing Group, their main revenue segment here. Of course, revenues down 36%. Their operating income absolutely tanked to 82%. If we look at how this played out over the last year or so, in Q4 of 2021, we had $10 billion worth of revenues. Those are down to 6.6 billion. If we look at this from an operating income perspective, 3.8 billion absolutely slashed down to less than $1 billion worth, and just 11% on those margins as well. Those have absolutely tanked. They're saying this is a result of lower demand. That's the least thing that you're going to want to see, especially when you're going through restructuring changes here, is that demand taper off here. That's going to be the same thing for their data center and AI group here. Another 84% decline year over year in that operating income. You can see the hit to revenues. You can see the massive hit down here to their operating income, just 9% margins here. Again, lower revenue on TAM contraction. Okay, their total addressable market is contracting, and they do also mention here that they have competitive pressure. Another thing investors are going to be very worried about here. Same thing can be said for Network and Edge Group. Now, operating income down another 84%. You'll see more of the same here. At least revenues were actually able to be maintained here at about $2.1 billion, but we saw further declines here in operating margins. Yep, just down to 3% now. More TAM weakness, not what you want to see at all. If we look at this from a full year perspective, at least in terms of their operating income here, again, year over year, at least on this quarter, 11 billion last year, 5.5 billion this year, absolutely slashed there. This quarter, from a full company perspective, they actually had an operating loss here of $1.1 billion. So, things are just getting from bad to worse here. From a full year perspective, though, they did still come out with about $2 billion, $2.3 billion in operating income. Now that was at almost $20 billion just last year. So you can see this has almost been a full 180, but it has been incoming. Now let's at least look at this from a liquidity standpoint here. Let's look at their current assets and their cash position here. They have about $11 billion of cash, $17 billion worth of short-term investments. Okay, so let's give them about 28 billion, just under $30 billion worth of cash on the balance sheet. What about their debt? Well, they have about $4.3 billion worth of short-term debt, with just about $38 billion worth of long-term debt. So not only is the fundamentals deteriorating from the top top and bottom lines perspective, but also on the balance sheet here where they have more debt than cash on that balance sheet. And you can see actually over here, debt has been growing as well, at least for this year compared to last year. So more bad news for Intel. Now, if we look at this from a cash from operating the business perspective here, they actually did not do too poorly here for at least this quarter with $7.7 billion in cash produced. They spent about $4.6 billion of that on capital expenditures here, left them with about $3 billion of free cash flow. When we look at this from a full year perspective, only $15 billion of free cash flow, spent $23 billion on capital expenditures to maintain and sustain the business while also restructuring, left them with a free cash outflow of $4 billion here. What are they doing to reward investors? Because they still are trying to do that. And this is where I think the management is failing. We'll talk more about that in just a second, but they're taking on more debt here and even more, as you can see over here. So about $10 billion was taken on, only paid down about 5 of that. And then they also paid out $6 billion worth of a dividend. So clearly this business has some issues here with their priorities. Now, if we actually look at the comments from the CEO, from the CFO, they say this is still in line with their strategy to reduce costs and everything. I would like to disagree, especially when you take a look down here at how this business has performed over the last year. Absolutely monstrous declines here, which has me really questioning the management at this point. I know that they are expecting to go through a challenging period here, but they're really making it harder on themselves by sustaining that dividend. If they just cut the dividend, rip the band-aid off, they'll probably do a lot better and they'll probably be able to sustain themselves a little bit better. But if we look at their Q1 2023 outlook here, they're expecting more of the same, more revenue declines down here, another 40% decrease. Gross margins are going to be hit now down to less than 40% is what they're expecting here. And then earnings per share should be another 100% decrease, in the negatives now. So a lot of bad things coming out of here. And it's really making me question the management team at this current point in time. We can see how over the past few years, we've seen that revenue deterioration. So now they're down to just $14 billion in operating income, for this year, with potentially more bad results to come for the year of 2023. So if we estimate here that Intel can produce at least about $12 billion in operating income for the next year or so. And if we require a 10% return, they still do pay that 5% dividend. If we expect that over the next 5 years, they're still going to have those impacts that they're expecting while they're really trying to restructure this business. If we say that they have deterioration of about 1% for the next 5 years, then once they do have those cost savings, once their massive spending in new plants pays off, we see more production of their chips, more demand. Let's say they can grow at like 5% for the next 5 to 10 years after that on a 10 PE like they're currently trading at, then the stock is actually fairly valued right now for a 10% return, assuming these growth metrics here. Now, in the very best case scenario, let's say 2023 ends up being a great year for them. They're able to grow at 3%, for the next 5 years, let's say. And then again, once 2025 comes around, they see those cost savings to kick in, a rebound in the economy, a lot more demand for their products here. They're able to bump that up to about 10% growth on a 15 PE. The stock would be trading back up to $54 per share. Now, after hours, if you're looking at this, the stock is down another 10% here, just about. But if we zoom out a little bit, the stock was at $68, almost $70 per share just in 2021. So to see it back at about $50 per share would be a major improvement here from the current levels here at $30 per share or less. Now, in the very worst case scenario, let's assume the worst is still yet to come. We see over the next 5 years, another 5% decrease in the fundamentals there. Then finally, again, once everything kicks in, and then 5 to 10 years after that, we see just a 2% increase in the fundamentals there. On an 8 PE, the stock would only be worth about $23 at that current point in time. We have to also consider they do have a net debt position here, so the fundamentals aren't even good, at least in the balance sheet. And from a liquidity perspective, the one thing that they do have going for them here is that they are cheaply valued at this point with just a 9 PE, 1.7 price to sales and 1.2 price to book. And I mean, they still are producing revenues at this point, in excess of $63 billion, which is still massive there. So there is some value with this business. Don't just get too hyped on all the fundamentals and the issues going on here. The market tends to overreact to things like that. And so we're down here at these levels here where even if we expect that this business can't even grow for the next 5 years, and then finally they make good on their promises, they can only grow at like 5%, they'd still be fairly valued right now for a 10% return from this standpoint. So something you need to take into consideration. The management team, I don't know right now though. I think if they focus on getting rid of that dividend or at least cutting it to a degree, that would really help out this business with their retransformation, but that's clearly not something they're interested in. The business is still being held up at this $30 price level down here. So we've seen in the past, if you look at this from a historical perspective, this is a definite area of support for this stock. So we'll see how this turns out over the year of 2023. But for right now, I'm giving this an investment rating of a 5. Okay. In my books, a 5 is a very average scenario here where it could turn out well, it could turn out poorly, right? And that's kind of the exact situation you're in here with Intel, where as long as they do make good on their promises, you will definitely see some stock appreciation and you'll collect that dividend as well, assuming they don't cut it, or if they do, that they reinstate it. Again, we have to remember, even with the 80% decreases to operating income, they still produced about $14 billion worth for this year. That is something to consider as well. But in the very worst case scenario, let's assume that the declines actually increase, the fundamentals get absolutely worse, there's less demand for their products, etc. in the future. Yeah, then we can see it won't turn out so well. So that's why I'm giving this a 5 as an either or, medium to high risk to reward ratio. Okay, so that's the analysis for today. Make sure to like the video and subscribe if you did enjoy. Also, make sure to leave your thoughts in the comment section below. And with that, I'll catch you on the next one.